Have you ever entered a breakout, price pushes above resistance, you feel confident, and then suddenly it reverses hard and stops you out? You did everything right. You waited for the level, you waited for the break, and still, you lost. That's not random. That's the difference between a real breakout and a fakeout. Most traders don't actually lose because they can't find levels. They lose because they don't understand what confirmation really looks like. In this video, I'm going to show you what a real breakout looks like, what a fakeout actually is, why the market creates fake breakouts, and a simple checklist you can use to stop getting trapped. By the end of this video, you'll be able to tell whether price is accepting a level or just grabbing liquidity before reversing. Market psychology behind breakouts. Before we talk about breakouts and fakeouts, we need to understand why breakouts happen in the first place. The market moves because of liquidity. Above every resistance level and below every support level, there are stop losses. Think about it. Retail traders sell at resistance, place their stop loss above it. Buy at support, place their stop loss below it. So what's sitting above resistance? Liquidity. And what's sitting below support? More liquidity. Now here's the important part. Big institutions cannot enter large positions without liquidity. If they want to buy heavily, they need sellers. If they want to sell heavily, they need buyers. So sometimes price will break a level, not to continue, but to trigger stop losses and create liquidity. That's where fakeouts are born. A real breakout happens when price breaks a level and the market shows acceptance above it. A fakeout happens when price breaks a level just to collect liquidity and then reverses. So the key question is not, did price break the level? The real question is, did price accept the level or reject it? So, what is a real breakout? Now, let's talk about what a real breakout actually looks like. Most traders think a breakout simply means price moves above resistance or below support, but that's incomplete. A real breakout is not just a break. It's a break with acceptance and continuation. Let me explain. When price breaks a level and it's real, you'll usually see 5 things. First, strong candle close beyond the level. Not just a wick, not just a quick spike. The candle closes clearly above resistance or below support. That close shows acceptance. Second, momentum expansion. The breakout candle is often larger than previous candles. There's displacement. It moves with intent. Third, follow through. The next candles continue in the same direction. Price doesn't instantly snap back. Fourth, structure shift. In an uptrend, you'll see a higher high forming. In a downtrend, a lower low forming. Market structure confirms continuation. Fifth, clean retest. Very often, price will come back to retest the broken level. But instead of falling back inside the range, it holds and then continues in the breakout direction. That retest is where professionals often enter. So remember this. A real breakout shows confidence. It shows acceptance. It shows continuation. It does not hesitate. It does not immediately reject. The market is saying, this level is no longer resistance, it's now support. What is a fakeout? Now let's talk about the trap, the fakeout. This is where most traders lose money. A fakeout looks like a breakout at first. Price breaks above resistance or below support, and it feels convincing. But then something happens. It fails. A fakeout is not just a failed breakout. It's a liquidity grab followed by rejection. Here's what you'll typically see. First, a wick through the level. Price spikes above resistance, but the candle closes back inside the range. That close is critical. It shows rejection. Second, weak follow-through. After the breakout attempt, price doesn't continue strongly. Instead, it stalls or immediately reverses. Third, fast snap back. Often the move back inside the range is aggressive. That's because once stops are triggered, there's no more fuel in that direction. Fourth, trap traders. Everyone who entered the breakout is now wrong. Their stops get hit, or they panic and close at a loss. That added pressure accelerates the reversal. Here's the key difference. A real breakout shows acceptance beyond the level. A fakeout shows rejection beyond the level. It's not about whether price breaks the level. It's about whether price can stay beyond the level. If it can't hold, it's probably not a breakout, it's a trap. Breakout versus fakeout. Side-by-side comparison. Now, let's put them side by side, because once you see the contrast clearly, you'll never look at breakouts the same way again. Here's the comparison. First, candle close. A real breakout closes strongly beyond the level. A fakeout wicks beyond the level but closes back inside. The close tells you everything. Wicks show attempts. Closes show decisions. Second, momentum. A real breakout shows expansion. Large candles, strong displacement. A fakeout shows hesitation. Small follow-up candles, loss of momentum. Momentum confirms conviction. Third, follow through. In a real breakout, price continues. It doesn't immediately return inside the range. In a fakeout, price snaps back quickly. Continuation versus rejection. Fourth, retest behavior. A real breakout often retests and holds the level. Old resistance becomes support. Old support becomes resistance. In a fakeout, if price retests the level, it fails again and moves aggressively in the opposite direction. Fifth, psychology behind the move. A real breakout equals acceptance plus new positioning. A fakeout equals stop hunt plus liquidity grab. One is structural continuation. The other is engineered liquidity. So when you're watching price approach a level, don't just ask, did it break? Ask, how did it break? Did it close strong? Did momentum expand? Did it hold the level? Because the difference between breakout and fakeout is not the break itself. It's the behavior after the break. The breakout confirmation checklist. Now I'm going to give you something practical. Before you ever enter a breakout trade again, run through this checklist. If most of these are not present, you don't trade it. Simple. First, did the candle close? Beyond the level, not wick, not spike. If the candle closes back inside the range, it's already showing weakness. Closes show acceptance. Second, is there strong momentum? Look at the breakout candle. Is it larger than previous candles? Is there displacement? Is there intent? Breakouts should not look slow and weak. Strong moves break levels. Weak moves fake them. Third, is higher time frame structure aligned? Are you breaking resistance in an overall uptrend, or are you buying into higher time frame resistance? Context matters. A breakout against higher time frame structure has a much higher chance of failing. Fourth, is there volume confirmation, if applicable? If you trade stocks or crypto, volume should expand during a real breakout. If price breaks but volume is low, that's a red flag. No participation equals no continuation. Fifth, are we in a high liquidity session? Breakouts during major sessions, London Open, New York Open, Market Open for stocks, are more reliable. Breakouts during low liquidity hours are more likely to be fakeouts. Timing matters. Sixth, is there room to run? After the breakout, is there clean space to the next resistance or liquidity zone, or is price breaking directly into another major level? Even a real breakout can stall if there's no room for expansion. If you start asking these questions before entering, you will instantly filter out a large percentage of fakeouts. Remember, professionals don't trade every breakout. They trade confirmed breakouts. The best entry strategy. Now let's talk about execution. Because even if you understand breakouts and fakeouts, if your entry is poor, you'll still lose money. Here's the approach I recommend. The break and retest strategy. Instead of entering the moment price breaks a level, wait. Let the candle close. Let the breakout confirm. Then wait for the retest. Why? Because the retest tells you whether the level has truly flipped. If resistance becomes support and holds, that's confirmation. If support becomes resistance and rejects, that's confirmation. Patience increases probability. Where to enter? You enter after. Strong close beyond the level. Small pullback to retest clear rejection in breakout direction. You are not chasing strength. You are entering after confirmation. Stop placement. Your stop should not be random. In an upside breakout, stop goes below the retest low. In a downside breakout, stop goes above the retest high. If price breaks back through that level, the setup is invalid. Simple. Risk management rule. Never risk more than 1 to 2% per trade. Even real breakouts fail sometimes. Your goal is not to be right every time. Your goal is to survive long enough for probabilities to work in your favor. Remember, amateurs chase breakouts. Professionals wait for confirmation. Common mistakes traders make. Now let's talk about why most traders keep getting trapped. Because usually, it's not the market, it's their behavior. Here are the most common mistakes. First, entering on the wick. Price spikes above resistance and they enter immediately. No close, no confirmation, just reaction. Wicks are attempts. Closes are decisions. Second, trading every level. Not every support and resistance level matters. Some levels are weak. Some levels have already been tested multiple times. The more a level is tested, the weaker it becomes. Third, ignoring higher time frame context. Buying a breakout directly into daily resistance. Selling a breakdown directly into weekly support. That's low probability. Always zoom out. Fourth, FOMO entries. They see a strong candle, and they panic. They enter late. Then price pulls back normally, and they think it's a fake out. Impatience creates unnecessary losses. Fifth, no defined plan, no checklist, no confirmation rules, no risk management, just reacting emotionally. And emotional trading leads to inconsistent results. Most fake out losses are avoidable, not by predicting the market, but by controlling your process. Final summary plus pro tip. Let's recap everything clearly. A breakout is not just a level being broken. A real breakout shows strong candle, close beyond the level, momentum expansion, follow-through, structure shift, and often a clean retest that holds. A fake out, on the other hand, shows a wick beyond the level, weak or no follow-through, immediate rejection, and trapped traders. The difference is simple. Breakouts show acceptance, fake-outs show rejection, and the key to avoiding traps is not speed, it's patience. Wait for the close, wait for confirmation, wait for structure to prove itself. Here's the pro tip. You don't need to catch the exact breakout candle to make money. You only need a confirmed move with probability on your side. Trading is not about being first. It's about being right often enough with proper risk management to stay consistent. If you start focusing on confirmation instead of excitement, your results will change. Thanks for watching. If you found this video helpful, make sure to subscribe to the Smart Trader Show and hit the like button so more traders can see this. I'll see you in the next one.